Thank you all for tuning in. Now, I can't promise you the outcome that you're gonna get from watching this, but what I can tell you, if you apply what you're about to learn, this will change your financial future. If you're here, it's probably because you're ready for change. And what you're gonna learn in tonight's training will do just that. So if taking back control of your money isn't enough to keep you glued to this screen for the next 90 minutes, I think it's time to reassess your priorities. And tonight, we've got a special guest. My good friend Brian is gonna be doing the training, and here's what you can expect to learn. Number one, you're gonna learn how to take back control of your money. And you're gonna do that by learning how to be the bank. Number two, you're gonna learn how to build wealth through your own debts and expenses. And you can do that without working harder, without working longer, and without taking on any additional risk. And number three, you're gonna learn how to get all the money back for every single car you will ever buy, drive, and own. That's exactly what you're gonna learn in tonight's training, so get ready, get set, let's go.
Take back control.
Tuesday night.
Tuesday?
All right, everybody. So welcome to this presentation. Before I get into this, I have a question that I always like to ask everybody to kind of set the stage here a little bit. And that question is this: what in life should you control? So think of three things in life that you want to control or that you should control. Now, for those of you that are new, use that chat box once again. What are one or two or even three things? I knew someone was going to say something like that. Tony said my wife, or Anthony said my wife, and I love calling Anthony Tony because he loves it, by the way. But what else in life should you control? Money, health, time. There you go. So the first one that everybody typically comes up with, or that we think about that we should control, is money, right? We think about, okay, I want to control money. Now, why do we want to control money? Because we think that controlling money is going to allow us to control other things in our lives, the experiences that we have, those kinds of things. But in reality, when you think about money in our lives, what are most people doing with money or to create money? They're trading the second thing, which is time, for money. So keep in mind, money is just a means of exchange, right? But in reality, a lot of us are being controlled by money because we have an employer who controls our money, right? We're not in control of it. Okay. Additionally, the second thing is time. We all want to control time, but we're giving that thing away. Now, here's something to think about: trading time for money. So time is very valuable, but one of the big epiphanies I had was time is my most valuable asset, and yet I'm trading it for money, right? But I realized that my employer is getting something of value, my time, but they're making more money off of my time than they're paying me, which means they value my time greatly because they're making money off of my time. That kind of it made me realize I probably should be doing something different, but there's nothing wrong trading time for money, by the way, but that was a big epiphany for me. And when I look at time and money, for me, the biggest thing, the most viable thing is not money, is time. I'll give up money to have more time control in my life. But there's one other thing that you should control before these first two things. And this is where a lot of people miss out on it, because if you don't control this first thing, you cannot control time and money as well. And that third thing is your mindset or knowledge, right? That is one thing you must control. And a lot of people don't understand that your mindset is what dictates the results you have in your life, or your subconscious programming, whatever you want to call it. So as we go through this presentation, we're going to be challenging that mindset. So I want you to keep an open mind. All right. Now I want to share this quote. This is one that we here at BYOB really like, and it's by Will Rogers. And it says, "The problem in America isn't so much what people don't know, it's what people think they know that just isn't so." So once again, keep an open mind. Now, I want you to think about this or envision this. Let's just say you take 100 18-year-old kids. So brand new kids, 18-year-old kids, just graduated from high school maybe, and you put them into a room. And then you ask every single one of those kids, where will you be at the age of retirement? Let's say 65 years old, okay? What do you think all those kids are going to say? I'm going to be broke and poor and destitute? Of course they're not going to say that. They're going to say, hey, I'm going to be wildly successful. I'm going to be a millionaire, a billionaire. I'm going to be so successful. But here's the reality. If you fast forward to when they're 65 years old, only five out of 100 of those individuals will be financially secure at that age, at age 65. Not 20% of them, not 50, only 5% will be financially secure at the age of retirement. And I find that just insane that we live here in the United States, or Canada, by the way, very prosperous country, and yet only 5 out of 100 people are going to be financially secure. And by the way, that stat is from the Social Security Administration that says only 5 out of 100 will be financially secure. Not financially free, by the way, just secure. So let me ask you guys a question, especially those of you who are new here. Do you want to be one of those 5 people, one of those 5%, or one of the 95%? So give me a one, give me yes if you want to be one of those 5 people. Shane says yes. Well, he's actually one of those 5%. So there you go. Kathleen, obviously, yep. Robert, Lisa. Okay, yeah. So obviously we want to be one of those 5. Now, why do I ask that question? Well, the concept that we're going to be talking about here today is a strategy that a lot of people who are at that 5% level are using in their lives. Okay, so pay attention, because this is one of the methods that can help you be the 5% and not the 95%. Now, before we get into this, I want to share, a quick background of who I am, because you might not know who I am. So I went to Washington State University, go Cougs, by the way, and I got a degree in construction management. So I did what everybody else around me was doing, or what I was told to do, by the way. And I call that now the hard way. And by the way, this degree, I don't even know where it's at. It's in my office somewhere here in my house. I have not seen it in years, and I have not used it in over 10 years, by the way, excuse me. So I call that method, though, the hard way. A lot of us did that in our lives, right? The hard way is a traditional path in life. So I was raised lower class, by the way. My parents are still together, great family life upbringing, but I was raised lower income, didn't really talk about money, didn't really, think about it all that much. We had a wood fireplace in the mornings. I had to go stoke the fire to get the heat up in the house, right? Because it was always freezing cold in the wintertime. But that was that traditional path in life. I was told, go to school, try to get good grades. I tried, and I did pretty well. Go to school, all that kind of stuff, get a job. And that's what I did. So I went and got a job in corporate America doing construction management and business, doing large projects around the US. Had that 401k and all that kind of stuff, right? Had the house, had the growing family, the white picket fence. I kid you not. It was probably cedar, not white, but I had all that kind of stuff. The student loans, the car loans, the credit card debts, everything. And I was told I had the American dream. You probably heard about that before. For me at that point, I'll be honest, it felt like the American nightmare. I was not happy. I was drowning. I felt like I was drowning. I just, something just seemed wrong, right? And I was at a doctor's office, and a lot of you heard me tell this quick story. But you know how they had those coffee tables with all the magazines, and we didn't have these things back then, these cell phones. So I grabbed a magazine, and it was a financial one, and I opened it up to this article that talked about millionaires, and it said that millionaires typically know their net worth, and everybody else doesn't. And I was like, oh, uh-oh, I don't know my net worth. I wonder what it is. So I went and looked it up and did all the math, and there's the piece of paper. I've lost it, but I took a picture of it, thankfully. And I was worth a negative amount of money after over about 10 years in corporate America, a negative amount of money, and it was going to get worse over time. So that kind of freaked me out a little bit. I was like, what the heck am I doing? Why am I doing this? But I really didn't know what else to do. But then something happened that was very personal. And so a lot of us have these kind of events in lives that kind of kick us in the pants, so to speak. And this was my grandfather, great guy, pillar of the community kind of a guy. My high school, by the way, like the football field is named after him. It's called Fouts Field. He was a coach, and he everybody loved him. I remember when he passed away, at his funeral were like over 1,000 people. It was crazy, but he worked really hard in his career so that he could retire and go travel around the country and go to sporting events, because he was big into sports with his wife, my grandmother, and he did that. It was kind of cool. He retired. They bought this little tiny RV, and for about a year and a half or maybe 2 years, they did that. They traveled around, but then he got sick. He got real sick. He got leukemia. He got something else, kidney failure, and then Parkinson's. And he ended up passing away. And for the last, I don't know, 3 years of his life, 4 years of his life, he couldn't even leave his house. And I remember he gave me a piece of advice during that time. He said, hey, go live your life now. Don't wait. I waited. Don't wait. And that really had a big impact on me. So I ended up kind of changing what I was doing. I actually left my career, got into real estate investing, and did some e-commerce, got into a financial education business. So that's what I did. And that led me to this business right here, where it taught investing strategies, taught financial literacy, and also taught what we're going to be talking about here today. So I used to teach this concept through this business, and I want to just kind of show this because this business did over 2 million revenue in the middle of COVID. Was an Inc. 5000 business, and the concept that we're talking about here today is what helped me grow this business. So that's kind of cool, but anybody can say anything on the internet. So I want to show you kind of some of that stuff, but that led me to doing a lot of cool things. I love experiences, right? Time is my big thing. So I like to travel. So here in a week, I'm actually taking my kids up to Alaska to my parents' property. And then we're going to Whistler, and then we're going to back up to there to go fishing and go do some crabbing and stuff at my parents' property up in Prince of Wales, Alaska here soon. So I love to travel, and this has led me to do that. And so you got some of you guys have seen me do these presentations while in a motorhome, traveling across the country, doing trips with my family. So that's what I do. But it's also led me to speaking about this concept on stage and sharing this, and that's what we're doing here today. I want to share this concept with you because it has made a massive impact in my life. I've helped over 1,000 people learn this concept and change their own lives, and now it's your turn. So there we go. Now, I want you to understand one thing, though. What I'm going to be sharing with you here today, it is not a new concept. It's been around for a very long time. We're talking about a couple hundred years that people have known about this. It's been around for quite some time, and there's people that I've learned from that actually talk about it. So one of those individuals is Robert Kiyosaki, Rich Dad, Poor Dad. He talks about this concept in his book, Second Chance. And I've been very fortunate to work with a handful of Robert Kiyosaki's personal advisors. Some of them were my mentors, and one of them was my mentor for this concept, by the way, but he talks about it in his book, Second Chance. Tony Robbins, I've been to 2 or 3 of his events in person, and they're phenomenal. But he talks about this concept in his book, Money, Master the Game. And then, of course, the foundational book on this whole concept, which I do recommend if you have not read this one, definitely read this book, Becoming Your Own Banker by R. Nelson Nash. He is the one that coined the phrase, the infinite banking concept. Also, Mapping Out the Millionaire Mystery by Brent Kessler and one of my mentors and friends, Chris Naugle. And then also the Private Money Guide by Chris Naugle as well. Now, if you guys want to get the bottom 2 books on PDF, I'm going to put my email into the chat box later on in this presentation, and I can email you a link to those books and some other resources that we have to help you learn more about this concept and how it can work for you. Now, let's talk about who has used this strategy throughout history, because it has been used by a lot of people. So Jim Harbaugh, he was one of the top paid college football coaches at one point in time, and he was compensated through cash value strategies like this concept. So that's how he was compensated. And if you might be asking, well, why would they do that? As you start to learn about this, you'll understand why they did that. Now, this gentleman, I think some of you remember who he is. Joe Biden. So he disclosed at one point previously that he has 6 of these policies with a company called Mass Mutual. So he's doing this concept. The president, or former president, was doing this. Walt Disney. So when Disney wanted to start Disneyland, he could not get any financing. There's a whole story about how he could not get any bank financing. Like 100 banks denied him. So he ended up using this strategy that he had in place to fund the start of Disneyland. So it's kind of weird. Without this concept, we would not have Disneyland as we know it today, most likely. Ray Kroc, so McDonald's hamburgers. So when Ray Kroc was partnering and then eventually took over McDonald's from the McDonald's brothers, he used this concept to fund the first 8 years of the growth of McDonald's. And so without this concept, we might not have McDonald's, which might be a good thing. Depends on your opinion right there. We might not have McDonald's as we know it today. The Pampered Chef, she did the same thing, borrowed from this to start the Pampered Chef, that brand. And of course, now I think Warren Buffett owns it for quite a bit of money. It's worth a lot. And then, of course, lots of wealthy families. And I've had personal experiences doing this with wealthy families. In fact, the JPs, the Morgans, the Chases. In fact, when you saw me on stage speaking, I was speaking to a high-level group one time, and in the audience was one of the sharks on the show Shark Tank, and he was the first one. The first original shark was in the audience, and his partner Mark, and he came up to me afterwards and said, "Hey, how you explained how we do this for our families is right, because we are doing it." And it was kind of cool to have someone come up and say, "Yeah, you're exactly right. That we, the wealthy, are doing this. It's a great strategy." It's kind of cool. Now, I want you to understand though what infinite banking, which is what we're talking about, is infinite banking. What will it do for you? So these are the things that it will accomplish. So one, it creates guaranteed tax-free, by the way. I need to put that in there, but it creates guaranteed generational wealth day one. Not year 30, not year 40, but day one, it creates generational wealth that is tax-free and guaranteed. It allows your money to grow uninterrupted compounding. So it compounds uninterrupted for the rest of your life with guarantees tied to it. I like the word guarantees, by the way. So I don't know of any other concept that allows this to occur while you can still use the money as well. It allows you to take control. So remember the first slide, or the first thing I asked you was control. So this allows you to take that control away from the big banks, from corporate America, from Wall Street, but it puts that control into your hands. And that is one of the more important things about this concept, is that you're the one in control of it. It also protects your money from lawsuits, from bankruptcies, from divorce, from lawsuits, creditors in most states, by the way, not all states. But it definitely protects your money in that regard and also privatizes your money. Now, the big thing, of course, it allows you to be the bank for things that you may normally use a traditional bank for. So think of things like investing into real estate, college, cars, homes, retirement strategies, other investments, all that kind of stuff. So you can be the bank, but here's the key, is that you're doing all of these things at the same time, all the benefits above at the exact same time, not one or the other. So think of like real estate investing. It's one thing, one benefit potentially. But what if you're doing that and this? Having growth of your money, compound for the rest of your life, generational wealth, you're in control, and you have the real estate investments all at the same time. So give me a one in the chat box. Give me a Y in the chat box if you would like to have all of these things happening for you in your life at the exact same time. Would that benefit you? Yeah, absolutely. Yeah, it works this way. You can ask some of these guys like Dex. You can ask some of the people on the call. Is what happening in their with their life right now? Yes. No, you still can't control the wife. She controls you, by the way. I know the truth. All right. Yeah, so this is what that does. All right. Now, don't take out a pen and paper, but take notes if you guys want to, because at the end of the presentation, the call to action is schedule a call with me. There's nothing to buy, nothing to purchase. There's nothing like that. It's just, hey, let's hop on a quick call. But if you want to take notes, and if you have questions down the road, we can hop on a call and do that. But also keep in mind, ask questions here. Use the Q&A box. And it comes up, feel free to put it in there, and we'll get those answered live. Now, this is a kind of a cool analogy, and for those of you that have looked this up, who have seen this presentation before, it's pretty hilarious. But I want to ask you a question. So who learns quickly? Well, kids do, right? Or remember when you were a kid, you learned how to ride a bike? But guess what? It's pretty simple. Now, once you hop on a bike, 5 years later, you haven't ridden one in 5 years, you can still ride that bike typically, right? You push the pedals, it goes forward, turn the handlebars to the left, it goes to the left, right? There you go. Pretty simple. Now, let me ask you a question though, but what if the bike did not work that way? What if when you hopped onto the bike and you turned the handlebars to the right, the wheel went to the left? It went the opposite direction, right? Pretty crazy. That's called the backwards bicycle, and it's a real thing. You can go Google it, and there's a video of a guy that's trying to ride the backwards bicycle, and he cannot ride it. He's falling over, and it doesn't work, right? Because his knowledge, the way he was trained to ride the bike, is not the same as a backwards bicycle. But what happens over time? So over time, he learns how to ride the backwards bicycle. Okay. Yet what happens when he tries to go back onto a regular bicycle? He can't ride that one anymore because he retrained the way that he rides a bicycle. It's the same thing around money. So what we're taught about how money works oftentimes isn't true. We're taught that use leverage, use debt to live your life, but then you find yourself later on down the road drowning in debt. So as we go through this presentation, I'm going to be challenging the way that you think about money, like the backwards bicycle. It's an analogy, right? So once you learn a different way around thinking about money, it's kind of hard to go back to the original way of thinking about money, like the backwards bicycle. So go Google it after the presentation. Pretty funny video. So what are the mysteries of money? Why aren't more people successful? So really quickly, what are the killers of wealth? So one, taxes. Like, I don't mind paying taxes, but I'm a lot happier paying less. Inflation, which, by the way, is the inflating of the money supply, which results in typically rising prices. But inflation kills wealth. Volatility, the ups and downs, like the markets, can kill your wealth. Interest, the average family pays over $20,000 a year in interest, which is insane. Mindset, of course, following that status quo, fear, FOMO, fear of missing out, life in general, by the way, and then just what we are taught around, money and other things leads us to not being successful when we believe that we should be, right? Okay, so really quick, what is the definition of money? So think of the definition of money as just a means of exchange. That's all it is. It could be seashells, it could be dollars, could be whatever, right? What company uses compound interest? So here's the thing. So nobody really uses compound interest. People think that banks use compounding interest. They don't. They charge you interest, but they don't use it themselves. Are your dollars worth more today or in the future? So this is kind of a good question to think about, because if you had a dollar bill 20 years ago and went into a candy store, you'd come out with a small bag of candy. You go into a candy store today with $1, you're going to come out with half a candy bar. I mean, seriously. So your dollars are worth more today than they are down the road. Yep. And Monica, great question there, a great comment. My son just purchased a car, or for me, I'd like to pay it off using this system. The interest rate is 25%. Oh, wow. Wow. Yeah, Monica, I would definitely look into this concept. I can show you how I'm going to go through a example of how we use this to pay off debts, because 25% is killing wealth right there. Yeah, and Anthony says not even half a candy bar. You're probably right. Do you think taxes are going to go up or down? I'm not even really going to answer that question. They're going to go up. Yeah, Monica, it was his first loan. Yeah, they get you. It's kind of weird. They actually, you get penalized for it being your first loan and not your second one. So right off the bat, you're digging a hole. Kind of weird. Yeah. And look at what Anthony just said right there. Paid off his wife's student loan at 60% with this method, saved over $50,000. I want you to, $50,000. Pretty powerful. All right, now here's something I want you to think about. So would you wait to eat bread or drink milk? Would you go buy it, put it in the freezer for 5 years, then take it out and eat it? Maybe it's doubled in the amount, but now it's all freezer burn and gross. Or would you go and buy like a Honda Accord car, like just a general car, put it in your garage for 5 years, and then start driving it after 5 years? Of course not. You would not do that, right? But here's the thing. What does a 401k or a retirement plan do? Well, you put your money into it, you don't use it or touch it, it grows slowly over time, and then you take it back out down the road and use it. So think about that for a second, okay? So you're putting good dollars to work, but you're taking it out down the road. But you would not do that with your car. You would not do that with food. But we do things with our money, put it into somewhere where we can't use it, but we wouldn't do that with things that money buys. It's kind of crazy to think about that. The other thing to think about this. So let's just say that you're a farmer and you're going to go buy some grain, and let's say it's going to cost you $5,000 to buy the grain, and then 6 months later you're going to sell it for, let's say, $50,000. Would you rather pay taxes on the grain, the $5,000, or the harvest, the $50,000? Think about that for a second. What would you rather pay it on, the grain or the harvest, the seed or the harvest? Well, most people, when they think about that for a second, are going to say, I'd rather pay it on the seed. I'd rather pay it on the seed, not the harvest. Well, then why do we do a 401k if it's the opposite of that? Because you're paying it on the harvest, not the seed. With infinite banking, you're paying taxes on the seed and not the harvest. So that's why eventually it makes a lot of sense to a lot of people. All right, so I'm going to give you an example of how money flows. Now, this is very important to understand when you look at borrowing and lending and interest rates and how interest is charged. So I'm going to keep this as a very simple example. So most of us have purchased a car. Monica is going through this right now, purchased a car. All right. So let's say you're going to go purchase a car for, let's just say, $25,000. Now, let's say that you at your local bank, you have $25,000 in that bank, and you're going to go to that bank and you're going to borrow that or take that money out of the bank as cash and go buy the car. But let's just say that the banker, call him Mr. Banker Bob. So Banker Bob says, well, wait a second, Brian, before you take the cash out, how about this? How about I pay you 4% on your $25,000, and then I give you a loan of $25,000 with your cash as the collateral for that loan? Okay, so I'm going to give you a loan of $25,000, Banker Bob, at 6%, and I'm going to pay you 4%. And we're going to do this over 60 months. So does that make sense? Would you want to do that, or would you want to pay cash for the car? Very interesting concept here. So you're earning 4%, but paying 6%. So here's the math on how this works, because math is just math, is just math. Your payment on the car loan, on that note, is $483. The future value of all those payments over 5 years or 60 months is $28,999. Now, what's the value of the money in the bank over the same time period? It's $30,525. So what just happened here? What's the difference? You just made $1,526 by doing it this way. Now, the argument that I get a lot from people is, well, Brian, if I just took out the 25,000 of cash and paid the car, I'd have no payments anymore. Well, yes, but you'd also have no cash. So how did you get the cash in the first place? Well, I saved it over time. I saved it, every month. Okay, if you just drained your account of all the cash, would you save again to build it back up again? Well, yeah. Okay, then this situation, the cash flow is no different. But in this situation, you made money, but the cash flow is the same. So how'd you make more money at 4% while paying 6%? Okay. It's earning compound 4%, which means you're earning 4% on an increasing balance, and yet you're paying 6% on a decreasing balance. Okay. It's just math. And we're going to get into some more stuff that's a more clear example. Yeah. Here's the three things we're going to cover in this presentation. So the machine, I'm going to go through what the machine is. How does this function? Then we're going to go through the marathon, because this is not a sprint, it's a marathon. Building wealth takes time, right? And then, of course, the last one, everybody's favorite topic, is how do you build wealth, the millionaire, with this strategy? All right, so what is the machine? So when you think about infinite banking, here's what I want you to envision. So think of infinite banking, the concept, like a car. What does a car have? It's got wheels, hopefully. It's got brakes. It's got a windshield. It's got a radio, mirrors, a steering wheel, seats, all that kind of stuff. Now, if your car or the infinite banking concept doesn't have an engine, can it go down the road? No, it cannot. It cannot go down the road without an engine. Make sense? So we have to have an engine to make the infinite banking concept, the car, function. So what is the engine? The engine is nothing more than a permanent, dividend-paying, whole life insurance policy from a mutual company specifically or specially designed for infinite banking. So that is the machine. Now, if you're thinking, well, what about why life insurance? Keep in mind, life insurance is just the engine that makes the infinite banking concept function. That's all it is. But they have to be specially designed with the right people that have the right training and the right companies, by the way. And it's not a large amount of people or companies that do this. Now, if you're saying, well, Brian, who else does this? I mean, why would I do this? Well, I want to share with you something called BOLI. So it's bank-owned life insurance. So banks, the traditional banks that you go and give your money to, that pay you a pittance, they own more whole lives, specially designed, by the way, than they do all of their real estate and buildings combined. You can go look this up, by the way. Go look up BOLI, bank-owned life insurance. They own tons of it. And I actually have, from their mouth, from executives and presidents of certain banks, have told me that, yes, you're right. The bank owns life insurance on me. Gee, I wonder why. Do they know something that we don't? They think so. But guess what? As we're going to find out, you can do the same thing. So once again, can you make money earning 4% while paying 6%? Yes, because I just showed that, right? So I want you to understand that. I'm going to make sure you guys understand that. Yes, you can. Now, in the first example that I gave you, who owned the loan? The bank did. Is that an asset to the bank? Yes, it is, because they're making interest, right? So guess what? Does it make sense to be both the bank and the borrower so that you own both sides of the equation? Yes, it does. And that is what the infinite banking concept is about. Now, to understand how banks function, I want you to see this example here, because this is how banks handle your money. So banks don't just sit on your money. So if you have, let's say, $100,000 and you give it to a bank at 4%, they're going to pay you 4%. Is that an asset or a liability to the bank? It's a liability. The bank doesn't just sit there with a liability in their lap, because that would not be good business, right? So what do? They put your money into motion. Money in motion makes money. And that's what the bank does with your money. So how do they do this? Well, guess what? When you give them money, they loan it right back out again, maybe on a home mortgage. But does the seller of the home, when they get that proceeds, the money, where does it go? Right back into a bank again. Now, does the bank sit on that money? Absolutely not. Goes right back out, maybe on a car loan or something like that. Monica says you're paying 25%. I'm only showing 8%. What's the car company do? Well, they put it right back into a bank again. What's the bank do? Pull it right back out again, maybe on a home remodel. What does the contractor do? Right back into the bank again. Maybe they do a debt consolidation loan. Credit card companies, where's their money go? Right back into a bank again. So if you do the math on this, the bank is making 500% more on your money than they're paying you on that money. By the way, it's just math. So there's the math right there on the screen. I'm not going to go through it, but they're making 500% more on your money than they're paying you. So does it make sense to be the bank? I mean, yeah, absolutely, right? And by the way, this is not just something I made up. Banks make between 400 to 1,300% on the money that you leave there. Go to BauerFinancial.com. You'll see it right there. But banks make a lot of money. And the kind of cool thing about that website right there, I believe you can go back in history and you can see what banks have made historically on your money. And go back 20 years ago, it's the same thing. It's pretty crazy. Now, to understand how to be your bank, you have to also understand the annual pattern of how we spend money, because you have to control money to be the bank, right? So let's look at a dollar. So for every dollar that comes into your hands or your household, where does it go? So approximately 20 cents of every dollar goes out to automobiles, payments, gas, upkeep, things like that. Okay. 30 cents goes to housing. So if you have a mortgage or rent, it goes to housing. Around 40% goes to everything else, things like travel, entertainment, food, blah, blah, blah. Now, that's 90 cents right there. So 90 cents of every dollar that comes into your hands goes out to somebody else. Kind of crazy. And then guess what? Whatever's left, around 10%, you save. Maybe into a 401k, maybe to somewhere else, whatever. But by the way, before COVID, that number was like 5 to 6%. During COVID, it went up. And then I think now it might be negative. Might be negative. I can't remember right now. Yeah, well, thanks, Shane, for asking the question, because Monica, I wasn't sure who Joe was. So yeah, Monica, if you want to clarify that, we can answer that question. So that's what it is right there. Now, I'm not going to talk to you about, what you're saving. I want to talk about what we're spending. How do we recapture what we're spending? Interest, by the way. So let's look at that. So let's look at what would happen if you moved all the interest that you're paying into your savings. Let's see what that would do. So on automobiles, as I said, 20 cents of every dollar goes to automobiles, but of that 20 cents, 5% is interest. Let's capture that back in the savings. On the housing, 30 cents goes to housing, but 25% of that is interest. That's if you have a mortgage. Now, if you rent, by the way, well, zero of it actually is interest because it's all gone. But let's say you recaptured the mortgage interest back into your savings. That's 25 cents. Okay. Then the last thing, everything else, 40 cents goes to everything else. Of that, roughly 5% is interest. Let's capture that back in. So that's what happens if you recaptured your interest, your savings goes up. And that's what you can do over time with the infinite banking concept. You can start to increase your savings because you're capturing that interest, you're capturing it back into your control. Oh, Monica, the bank. So Joe, yeah. So yeah, what would happen in that situation, which you'll see here in a moment, is you're paying it back to your banking system and you benefit because of that. So yeah. Yeah. So instead of going out to the car company or whatever it is, you're capturing that control back through your policy, and you'll benefit from that. And you'll see here in just a second. In fact, that's the next thing we're going to go through. So what I want to show you right now is how to get all the money back for every car you'll ever buy, drive, and own. Now, this is an example. So before I get into it, though, and by the way, I like classic cars. If you guys couldn't tell by the pictures, I have my current car is a Mercury Cougar that I can't drive because it got so cold it blew the freeze plugs on the engine this winter. So I've got to fix that before I can drive it. But anyways, I love cars. So let's look under the hood. So this is what we call a kind of an illustration, tabular detail of a potential policy. So what you're going to see on this is right here. So we're going to see some deposits going into this policy. And I'm not going to call those premiums or bills. I'm going to call them deposits. Why is that? Well, on like a car insurance or home insurance, you have an expense that you have to pay every month or however often, and it's an expense. You don't get value out of that unless something bad happens, right? With this, it's different. When you deposit into the policy, you get cash value that you can borrow back out of the policy. Okay, so we call those deposits. And you'll see that right here. Okay, and you're going to see that you have cash value, which as you fund these kinds of policies, these specially designed whole life policies, you can borrow out of them right off the bat. You can borrow, take money out to go do whatever you want. age. So a lot of people think about, well, guys, this is life insurance and I'm old, so I can't do this. Not really true. Age doesn't really matter because you can do policies up into your 70s, by the way, certain ages, but you can also do policies on other people in your life. So maybe you can't get a policy for whatever reason, or you're too old, or whatever you think. Well, guess what? I mean, I have a lot of clients that are doing policies on other family members, spouses, business partners, siblings, etc. Okay. Yeah. Yeah, there you go. Yeah, everybody read what Anthony just put in there. Death benefit. So when everybody hears insurance or life insurance, they think death benefit, death benefit, death benefit. We're not going to really focus on death benefit, by the way. Okay. We're going to focus on living benefits. The death benefit is a side benefit, but not the main focus. Okay. Oh, and also, by the way, so when I go through this example here, it's going to be very, very, very conservative. So as Anthony noted right there on his policy, he's getting a lot more back right now. But on this one, I'm going to be super conservative on the numbers. I typically would build them to be a lot more efficient than what you're going to see here. But once again, I want to set a baseline right down here so that when you see what your numbers will be like, they'll be like up here. Okay. But once again, I'm going to be very conservative on this example. So in this example, this person is going to put in deposits into their infinite banking policy of $10,000 per year. Now, $10,000 is just an arbitrary number, right? It could, your numbers are going to be your numbers. And I'll let you know what those are on a private call. But this is just an example at $10,000. Yep. Yeah. Okay. So now, as you can see, as we deposit that $25,000 or that $10,000, you're getting cash value coming back in your money account right here, your multiplier account. So you can see that cash value. At the end of year 3, you have around $25,000 of cash value. So what do? Well, you go to your bank, you borrow out of that bank. That's called a policy loan. And that's your loan, by the way, which I'll talk about in a little bit later, but that's your loan. You control this loan, not a bank, not the insurance company, by the way, but you control this loan. But you're going to be a responsible banker. So you're going to pay back that loan. Let's do it at $500 per month or $6,000 per year. What's that look like? There it is right there. So you pay back this loan of $25,000 at $6,000. There's interest built into that, by the way. And then at the end of 7 years, what are the numbers? Okay, you put in deposits of $70,000. You also paid back into the policy loan $30,000. So that's $100,000 that has gone into this policy. Yet you took out $25,000 of cash, right? That's cash, and you paid cash for that car. So that's $25,000 of cash that you got back out. So in reality, you put in $75,000 of monies into your policy. But here's the thing. Now, keep in mind, this is very conservative. What do you have in cash value? $67,000. You've recaptured 91 cents of the $70,000, and you own the car outright. But here's where infinite banking really kind of flips the table or flips the script a little bit. Let's look at years 8 through 12. Now, this is an optional thing. You do not have to make any deposits if you don't want to after year 7. I recommend you do, but you don't have to. Okay, so I'm going to show you once again, very conservative numbers, why this is so powerful. So you don't make any payments years 8 through 12. But guess what? Maybe your kid turns 16. My daughter's going to turn 16 here in 2.5 years. God help me. So you go buy a car for her, right? So you go buy a car. That's another $25,000. So you take a loan out, do the exact same thing. You pay that back over time. So now what does years 8 through 12 look like? Well, you paid $30,000 to the loan, but once again, you had $25,000 of cash. So in reality, you only put in $5,000, but guess what? Between years 7 and years 12, because of the uninterrupted compounding, those are called dividends, by the way, they don't stop growing. You actually grew your policy by $23,592, and you only put in $5,000. So let's do the second set of math. So that's just math right there, by the way. Let's do the second set of math. How much did you put in over 12 years into this policy? Well, $75,000 years 1 through 7 and $5,000 years 8 through 12. That is $80,000. But you have $91,473 of cash value that you can now use for whatever you want, and you own 2 cars outright. You made money over this 12 years and you own 2 cars outright. So that makes sense. Hopefully it makes sense, guys, because that's a simple example. And by the way, we would map this out for you to do this. But yes, that's exactly how it happened. You made money and you own 2 cars outright. If you just gone to a car company and paid loans back, you'd be out of pocket and not have made any money. If you paid cash, you'd have 2 cars outright, but no wealth, nothing left over. So that's how it works. Now, there's 3 rules with infinite banking that we want to follow. 1 is pay yourself first. Rule 2, be a responsible banker. And rule 3 is recapture and recycle your money. So here's those 3 rules. Pay yourself first. That means, where does your money go first? It doesn't go out to the car company first, doesn't go out to your credit card companies first. It goes into your policy first. That's where you capture that money first there. Second rule is pay yourself with interest. So when you pay your policy back, there's interest tied to that loan. Pay it back with the interest. Be responsible. And the third thing is recycle and recapture your money. So use your policy. That's what that means, is use the policy for banking functions in your life. Now, works for a car, as I just showed you. What else does this work for? All right, debts. So one of the biggest things that a lot of our clients use the policy for first, by the way, before they build wealth, is to pay down debts faster and to recapture that money back into their hands. So in this example, this person is a doctor, by the way, has total debts of $478,000. The total payments are almost $6,000 per year, around $5,777 per year, and that's $69,000 per year of debts. If they were to pay off all of these debts as planned, guess what? 19 years and a lot of interest, probably. Make sense? Okay. So this doctor said, I want to do infinite banking. And so once again, very, very, very conservative numbers here on this policy. My policy's ideal build would probably be a bit more efficient for you, but once again, I want to be very conservative on these numbers. So total debt, where'd it go? Oh, we'll come here in a second. All right, so here's what we did. So on this doctor, so what we're doing is they're going to do a deposit of $25,000 annually on this policy. Now, the question a lot of people ask is right here is, well, Brian, where do you get the $25,000? Well, one, that's just his numbers, by the way, but he's a doctor. Okay, so he has higher income. Now, where did the money come from, though? Well, he had money going to 401ks, some other like plans like that. And so he said, well, wait, I'm going to take some of the funds going to those plans, which I don't like, but I don't have any other choice, and I'm going to put it into this policy. So his cash flow didn't change at all. He just moved it from one bucket to another bucket, infinite banking. Okay. Now, when he puts that first $25,000 in, he has around $14,863 of cash value available within 30 days that he can borrow out. So what does he do? So he borrows out the $14,000 and he pays off the Discover's card, the Lowe's card, and part of the Nordstrom's card. Okay. So pays those off. What happens? Well, his debt drops down, but his monthly payment goes from $5,777 to $5,329, which means he's saving $448 per month. But he doesn't just let that $448 go out the window. He recaptures that back. So in years 2, another $25,000 goes in, right? Cash value jumps up by $16,571, and the payments of $448 back to himself equal $5,374. So the total cash he has available is $21,945. Now I'm going to stop for a second because Crystal asked a question right here. She says, my question is, how is this beneficial? Even though you build cash value in your policy, when you pass, the insurance company gets your cash value, not your beneficiaries. That's incorrect. So your so when you pass on, let's say you have $200,000 of cash value. Your death benefit is $500,000. Your cash value is a portion of the death benefit. You're allowed to borrow a portion of the death benefit. So cash value of $200,000, your death benefit is $500,000. They're going to get $500,000, significantly more than your cash value and significantly more than you put into the policy. So it's massively beneficial. The insurance company does not get your death benefit or your cash value. That's a myth that some people say is not true, because your death benefit is always more than your cash value because it is part of it. Yeah, you're borrowing from your death benefit. So, but good question, Crystal. I like that kind of question because it challenged me, right? Challenged me because I'm going to explain more about how this works, and you'll see the numbers. I'm actually going to go through that a little bit more in more detail. Okay. All right. So back to this example. So at beginning of year 2, he borrows the $21,945 out of the policy, and he pays off the Nordstrom card, Wells Fargo card, private loan, and part of the BMW. Now, and by the way, his monthly payments drop down. So now he's recapturing $1,917 of his payments back to himself now. So in year 3, same thing. 25,000 goes in, cash value jumps up by 25,541. Payments back to himself of the 1,917 are $23,004. So his total cash that he has now available to put to work is 48,545. Same thing happens again in beginning of year 3. Pays off the BMW, pays off the West Marine. I'm assuming a nice boat, hopefully a fishing boat, and then pays off part of the condo. So his monthly payment now has dropped by 3,677. So he's recaptured that much cash flow, right? Okay, that much cash flow. Make sense? So that's the end. That's year 3. Kimberly asked a question. I was told the outstanding loan was deducted from the cash value. So if something, so let's say you have a loan outstanding, and I'll go through this, and you pass on. Death benefit is $500,000. Cash value is $200,000. Loan is $100,000. Your death benefit is paid out less the outstanding loan. Then the insurance company is made whole, because that's a debt that is owed right back to your banking strategy. So yes, it is deducted from the death benefit, not the cash value. Yeah, good question. All right. So now I'm going to stop for a second, because what's happened so far with this policy? So he's put in, or we've put in this example, $75,000. But what have we taken out? Well, around $55,000. So how much is in the policy and how much is earning dividends for you? Well, a lot of people would say, well, only $20,000. But guess what? No, you're earning the dividends on the total policy itself. Okay. So when you borrow from these policies, it does not interrupt the growth of the policy. It still goes up over time. Pretty powerful. All right. So let's go to year 4. What happens in year 4? Same thing happens, right? 25,000 goes in. That's his deposit to fund the policy. But the cash value goes up by 26,000 and change. So it's going up by more than he's putting into it. The payments back to himself of the 3,677 is 44,124. So the total cash this guy has to borrow back out at the beginning of year 4 is 70,439. So he borrows that out, wipes out a huge chunk of the condo. Now his monthly payments do not change though, because the condo and the house are amortized loans, which when you pay a principal off on those ones or pay it down, the loan amount doesn't change, or sorry, the payments don't change. Okay, so it's the same. So year 5, 25 goes in, cash value goes up by 27,000 and change. Payments back to himself are 44,124. Cash available, 71,225. So now we wipe out the entire condo loan and a big chunk of the house. Monthly payments drop down to only 1,221, and he's recapturing now 4,556. So the next year, which is year 6, the doctor says this. So he says, hey, you know what? This policy is awesome. So I want to do a second one because I see the value of infinite banking. So he decides to drop the first policy, the premium deposit, from 25,000 down to 10. So that's what he does. So he puts in 10,000. You can see it right here. Puts in 10,000 deposit, but the cash value still goes up by more than that. It goes up by 13,092. The second policy, because now he's got more income coming in. He puts in a $25,000 deposit into that policy. Cash value is 14,863, available within the first 30 days. Okay. The payments back to himself of the 4,556 equals 54,678. So the total cash he has now is 82,633. But the house, which has gone down through the previous 12 months because he's making payments on that, is only $76,000. So what's he do? Well, he wipes out the house payment with the loan. His payments go down to 0. And now he has no more commercial debt or consumer debt. Now in year 7, what's he do? In year 7, he takes that 5,777, the monthly payment that was going to the credit card companies or the debt companies, and now he pays back his policy loan. And at the end of year 7, he's 100% debt free and has multiple 6 figures of wealth inside the policy that he can now put to work. And he has a 7-figure death benefit, by the way, a 7-figure death benefit the entire time that he can use, hopefully not ever, until he's older, right? There you go. Now, if you're saying, well, Brian, that's a lot of math. How do you do that, right? This is a lot of stuff going on. Well, guess what? We have a Debt Blaster software that maps this out for you to show you how to do this, so that you actually will know when you'll be debt free. So this is exactly how it works right here. So we have the software that we use for our clients. There's no cost to this kind of stuff, by the way, but we will show you how to use the policy and your cash flow for the debts. Yeah. Yeah, there you go. So yeah, so Shane had made a comment because I had a guru who helped me get my debt in order to and tell me not to get a policy because it's my own money. I listened to him just over 4 years ago. He's correct. It is my money, but he left out that I can use it and it compounds and grows, but it's has a death benefit as well. Yeah. So they leave out some certain key things, don't they? Sometimes. Yeah. So there you go. So yeah. So by the way, one of the things that we do for our clients is we have a called an implementation team or implementation agents that will help you map out what you're trying to accomplish. I just gave you an example of a car and debt, but there's lots of other things that I'll show you in a moment that you can use infinite banking for. And this is where a lot of people have that kind of that epiphany or that aha moment about how this can work. So for what was her name? Like Crystal. So yeah, so there's a lot of people have like these misconceptions about it, but there will be that aha moment, like, oh, okay, now it kind of makes sense or it clicks, right? Whoops. So the last kind of section we're going to cover is like, how do you build wealth with infinite banking? So the question is, and I have a lot of clients like this, well, what if I don't have any bad debt? What if I don't need that new car, right? And that actually, as someone who I just was on, Jeremy, I don't know if he's still on. His initial intent was to get a new car for his wife with the policy, but now they're looking at doing some remodels. And so he said to, hey, wife, do you want the new car or you want to have a remodeled house? And she's like, let's wait on the car and do the remodel. So he's actually doing that. It's kind of cool. But can you benefit from privatized banking and you still become your own banker? Well, yes, because once you've gotten rid of the debt, don't need those cars, that's where wealth is built. That's where it kind of gets kind of fun, right? So here are some other ways that people use infinite banking to create wealth. So real estate investors. So a lot of our team, a lot of our clients do a lot of real estate investing with infinite banking because now they're controlling all aspects of the transaction. Commercial properties. So think of like apartments, mobile homes, things like that. Land investing, by the way, I got a client that's getting ready to do that. Private lending. So think of like private funds, which is kind of funny. So when you private lend, which I'm going to show you an example here in a moment, you're being the bank with your policy, and then you private lend it, and you're being the bank again, which means you make even more money. It's kind of cool. A business owner, so a lot of business owners will use infinite banking to become like their own line of credit, maybe fund their retirement strategy from their business, buy sell agreements. They might do it for like key employee insurance, things like that, which we help you set up, by the way. Stock and options traders. I don't know a lot of people doing that, but I do know a few. Startup. So I've have a lot of clients that are getting ready to start a business. They have a bunch of money they're going to use as their startup capital, but they put it through the policy first to make sure that they capture the money there first. And then of course, equipment flipping. So that's kind of a unique one that some of our people do where they buy like forklifts, fix them up and resell them. All right. So now I want to show you some real examples. So let's go through some real examples of how this works. So this is for private lending money. So think of like investors that want to lend for doing like rehab projects, things like that. So in this example, this person is putting in $50,000 a year, and they're doing what is called a lump sum dumping, where you have the option with these policies to put in a large amount up front to overfund the cash value very early on. And so this person is putting in, once again, $50,000 deposit, whether it's monthly or quarterly or annual, doesn't really matter. And they're putting in a $100,000 lump sum at the same time to overfund the cash value. So what I want to show you is how this works a bit down the road. So I'm going to go to year 8 just to show you some numbers of how this thing grows over time. So in year 8, the cash value went up by 66,722. But guess what? In that same time frame, or the same time frame, you only put in 48,594. So you put in 48,594, but the cash value increased by 66,722, which means that it grew by 18,129, which is a 37% cash on cash return. Pretty darn good. I know a lot of people here would love to have a 37% cash on cash return on their money. Well, this will do that if you do nothing other than just park your money here. But guess what? Put it to work. The whole purpose of infinite banking, by the way, is to put your money to work outside of the policy. So how's that look? So let's say you private lend the money at 12%. So 12%. Yeah, Jeanette, thanks for being here. Now, you're already making 37%. So you made 12 plus 37, and you're going to pay, let's say, 5% interest back to your policy. That's your loan, right? You're paying it back. That's a 44% cash on cash return on your money in that given year. That's insane. So we did nothing other than where our money goes first. Okay. So Quick question. Give me a 1 if you'd rather make 44% versus 12%. Give me a 1, a Y, a yes, or whatever in the chat box. Well, I take some on. I mean, that's what you can do. And we got people, by the way, in the chat right now that are private lending their money from infinite banking, by the way. Yep. And so we have people that are making these kinds of cash on cash returns by doing this as an example. Make sense? All right. So uninterrupted compounding, that's why this can do what it can do. So this is an example of some of the math on uninterrupted compounding. So in this example, this person puts in a $50,000 lump sum dump in. Okay, they put that in upfront, and they're going to put in around 5,895 per year. All right, excuse me. And so you can see right down here. So in year 5, their cash on cash is 26%. Access to capital is 126%. Year 15, cash on cash, 115, 115%. Access to capital is 215, 215%. That's why uninterrupted compounding is so powerful. Those percentages right there just get bigger and bigger and bigger the longer this is in place. Yeah. Anthony, you, me both. Well, maybe 40. So the millionaire method. How do you eat an elephant? It's one bite at a time, because the man at the top of the mountain did not just fall there. So what do I mean by the man at the top of the mountain? So when we see someone who's successful, or they're where we want to be, they're sort of at that top of the mountain. We want to be there. Oh my gosh, I want to get there as well. But what do most people do? They keep walking around the mountain. What did the person who's at the top do differently than walk around the mountain? They started to take that climb up the mountain. They had to climb up the mountain. Most people don't start doing that. That is one of the biggest challenges. You've got to start climbing the mountain to get up to the top. Okay. So it's kind of something I want to share. So if it is possible to owe no man nothing, right? Is that really possible? Kind of, I guess. But the machine works for debt and expenses. Okay. Vacations, homes, everything else. It works for all these kind of things. And so in fact, I use it for taxes. So I actually will take my monies that I would pay to the taxes, because I'm privately financing this house. I put it into my policy, and then I pull it back out whenever I need to pay my taxes. That's just how it works. Yeah, Frank says the power to the penny, 30 days. You'd be a millionaire if you doubled the penny every day for 30 days. You'd be a millionaire. Crazy. All right. So now that you know that you should how this works, I truly believe that everybody who can do this should do this. Now I'm going to talk to you about that in a second, but because not everybody can do this, you do have to qualify, and not everybody does qualify. And I also believe that you should teach this to those around you, and you should pass this down through the generations, because wealthy families do this generationally because they know how powerful it is. I showed Jeremy this morning, and he was like, "Holy cow, that's awesome!" He's going to set his family up for the next generations. It's incredible. So the next step is, and by the way, I have more slides. We're not done. I got a few more slides here, but to schedule a call with me, you just go to brian.beyourownbanker.com/TBCT. And also, I'm going to go ahead and put in my email address into the chat box. And then if you guys want those PDFs that I showed at the beginning, go ahead and send me an email or click that link, and I'll go ahead and send those to you. And there's my email, which is brian@chrisnaugle.com. So this is kind of a funny slide I want to share with you right here, because I was always that guy at the bottom, and I feel a lot of people are that person on the bottom, where we are working for our money, but the ultimate switch we want to have is to make our money work for us, and that is the guy at the top making his money work for him. Make sense? So that's really what being your own banker can do for you, is help you start getting your money working for you. And yes, it takes time, like everything else, but it's definitely worth it. So by the way, so here's some things I want to share with you, because these are some of the more common questions or things that have come up on our calls. So I didn't talk about the death benefit. So I'm going to talk about the death benefit for a second here in a moment. The loans. People think of a loan, they think of, oh, I got this payment. Well, guess what? They don't have to be repaid. You should pay them, but you don't have to. I'm going to cover that here in just a moment. The internal values inside the policy, as it's growing, is growing tax-free. Not tax deferred, by the way, but tax-free. If you do it the way that we actually show you. The policies, as I said before, they are exempt from judgments from liens in most states. Tax-free income. So you can create tax-free income in retirement with this, by the way, if you want to. It's one of the ways that people use the policies, is to create tax-free income. Okay. Hopefully says, hope I pronounced that right. Brian says, how does one qualify? So it's the application process and underwriting process with the insurance company. So it's financially and medically are the two main ways. So health-wise, and then financially, you got to qualify. And I can walk you through the qualifications on that. So, all right. So one of the biggest things about infinite banking is it has an always increasing generational wealth strategy. Tax-free, by the way, and guaranteed. I'll keep using that word guaranteed, by the way. So you'll see on this example, this is a female, age 42, putting in $20,000 a year for 5 years. And then she decided to drop it down. She doesn't have to, by the way, but she can. Going to drop it down to $3,257 right there. But look at the death benefit. In year one, these are end of year numbers, by the way. At the end of year one, the death benefit is $325,000, and she's only put in $20,000. Okay. So I think somebody asked that question about, well, the life insurance company gets your cash value. No, the 17,000 right here is part of this 325. That's what's really happening right there. So how many times the $20,000 is 325? It's a lot. Now look at year five. Year five, she has put in $20,000 times 5, so $100,000 has gone in. She has basically $100,000 of cash value available, and it keeps getting bigger and bigger. And the death benefit has grown to 483. So the death benefit goes up over time. So you think generationally, this is going to increase every year for the rest of your life and be available tax-free for that next generation. But it's worth almost 5 times what she has put into this thing. So you're multiplying your wealth, your money for that next generation. So that's how the death benefit can work in your favor eventually. So policy loans. The policy loans are guaranteed, by the way. So there's no credit check. There's no like approval. You get them in a few days, typically. Ask and you shall receive. The other thing to keep in mind, this is very important about this concept. So the loans are private. So the contract that you have with the insurance company is your loan, or your contract, by the way. You own that contract, but it is private. So your loans are also private. So they do not go on your credit report. On those loans, there's no interest payments. There's no annual payment. There's no payment required. Now you should pay it back, right? As we teach you, but you're the one in control of that loan, not the bank, not the credit card company, not the car company. You are the one in control. Miss a payment, nothing happens. If you have a car loan and you miss a payment, what happens? Your car is not in your driveway when you wake up in the morning, right? You miss a payment here, go look at a mirror because you're the one responsible. All right, a couple things. How can I fund my bank? How do I fund my bank? Well, you can do it monthly, you can do it quarterly, you can do it annually. It's up to you. What is the range of what you can fund the policy with? So there's a range, okay? So it's going to be 10 times your age. So if you're 50 years old, 500 on the low end, which that's fine, but we don't recommend that unless that's your cash flow. On the high end, it's going to be based upon around 15 to 25% of your gross revenue divided by 12 for monthly. There you go. Yeah. Well, so Anthony, so on the company, they add the loan to the interest to the loan balance, right? So they don't require you to pay the interest. They just add it to the loan balance. So keep that in mind. Now we like what we're talking, we recommend you make that interest payment though, so it doesn't compound on top of itself. Yeah. So yeah, both correct. So keep in mind, so that's the range of what those are. And on the call with you, and by the way, the call is with me personally, by the way, I would walk you through the minimums, the maximums, all that kind of stuff. So on top of the premium deposit, so you can also do what is called a lump sum dump in, where you can put in, $5, 10, 15, 20, 30, $40,000, a larger amount on top of that to overfund the cash value. Because when you do those large dump ins, 90% approximately goes to cash value and is available within 30 days. So whenever you're doing this, understand that a majority of what you're putting in is going to cash value. And eventually, as you saw on the illustrations I showed you, every dollar you put in, you're going to get more than $1, right? More than $1 of growth in the cash value. So it just takes time, those dividends. You got mine yours in a week in your loan. Yeah, it's kind of varied. I've heard different numbers from people, different timeframes of when they got the loan. I had one client get it within the same day. Someone else, it took 6 business days. So it's kind of changes. Depends on the amount you're getting to as well sometimes, because sometimes it takes some time to clear the bank, right? So the question is someone says, well, Brian, so I'm not getting 100% out of it. As I said, long-term strategy, but would you put $1 in order to get $3 out? What do I mean by that? Let me show you. So this is another example of a policy. On this one, it's a female, age 32, putting in $10,000 premium deposit per year, doing a lump sum dumping of $50,000. You can see it right up here in the right-hand corner. So 60 went in that first year. At the end of the first year, access to capital is 55,533. So if you do the math on this, do 55,535 divided by 60, they have access to 93% of what they put into the policy at the end of the first year. But what's it look like down the road? So year two, they put in $10,000 year two. At the end of year two, the cash value went up by $10,607. Okay. Now, what's it look like even further down the road? Let's go to year 11. In year 11, this person decides, I'm going to drop my premiums down. Okay, I don't want to put in the 10,000 anymore. I'm going to put in $3,120. But guess what? The cash value at the end of the 11th year went up by $10,590, over 3 times what they put into it. So would you put in $1 to get $3 back out? Most people would say absolutely yes to that right there. And that's exactly how this one is working right there. Now, I'm going to share with you this quick quote by Warren Buffett. And I don't quite like this one, but I want to share it because a lot of my colleagues like this quote. So it says, if poor people would just do what rich people do, they wouldn't be poor anymore. I don't like that quote. I like this one better. If poor people had the knowledge of the rich and took action on that knowledge, they wouldn't be poor anymore. Because knowledge is power, but knowledge plus action is powerful. And you have to be powerful to actually really do this. Yep. Kathleen says, why do people drop their premium deposit? Various reasons, retirement, income goes down. Sometimes you have to do it over time. You don't have the option because the policy is growing so fast. The cash value is growing too quick and you've got to drop it down automatically. They want to start a second policy. So they want to do a second policy. So they're going to take the cash flow that was going into this policy and do a second policy to plant another infinite banking tree, so to speak. Yeah. Monica says, so I can also deposit into account my IRS refund. Yeah, that's just cash. Absolutely. I mean, if it's already built or not, depends on if your policy has been built or if you have a policy loan or whatever it is. But good question though. Like if you have a policy already existing and you have a loan that you've taken out for like debt recapture and you get an IRS refund, it's just cash, but it's not really enough to start a second policy. Don't park that cash in your checking account or your bank account because that's the bank's control. Park that IRS refund in your policy loan, keep making payments back to your policy loan as you normally would, but now you're paying less interest on that policy loan because you park your cash there because the cash value is just a liquid asset. So you're paying less interest in that regard. So lots of ways to do it. So another question I get is, well, Brian, why should I work with you? Okay, well, I've been teaching infinite banking now for about 9 years, helped a lot of clients do this. But we here at the Money Multiplier, we have an entire team of about 40 plus people that do infinite banking. So you're working with not just a couple people, but a team that works with you. Our team, we are the largest producer, approximately, we believe we are, of infinite banking in the US. We are the largest broker for 2 of the companies that we work with by a large margin. Yeah, I think right now, I think about 100 clients in underwriting, I believe. So there's quite a few of them doing this, or my own personal clients. We also provide you with ongoing support and ongoing services. So if you need help using the policy, hey, how do I do this? How do I pay this? How do I structure this? How do I change this? We work with you ongoing. So it's not like it's a one and done thing. I have clients, I mean, Anthony and these guys are my clients, they're working with me. Right? And they have policies. So we help them use the policies and there's no cost to you. We don't charge you anything. There's no fee to get started. None of that kind of, BS that you might hear otherwise. So yeah, so that's part of it. But we also use this in our own lives. Like I can't be sitting here talking to you if I'm not doing infinite banking in my own life. Yeah. Yeah. So Monica, you do need a bank account to do anything like to transfer and do transactions. So yes, you do need a bank. Yeah. Because they need a place to transact. Frank said, can you pay your loan off early? You can pay it off in the next week if you wanted to, Frank. Yeah, you can pay it off whenever you want. I mean, I've had people do that. Borrow it out and a week later, pay it right back. Sessing asks, do the insurance company have to do a health check on you? Yes. Not always, but most cases, yes, they do. There's no cost to you on that one. It's a mobile nurse. You schedule it on your calendar, but yeah, it's you do that, yes. And see, your Anthony says, yep, to be sure that you are insurable. Yeah. It's kind of funny. Lucia here, she didn't know that she could open policies for her grandsons. And then I had a whole presentation I did on juvenile policies and how they work. And she's like, oh my gosh, I can do that. Like, yes, you can. You can actually open them up, called the grandparent policy. Yeah, Frank, yes, you can. So there you go. And then another question I get quite a bit is is IUL or VUL infinite banking? Flat answer on that one is no. IULs and term insurance pay some of the highest commission out there in the industry for what they do, and we take a pretty massive cut to do infinite banking. About 70% cut in commission to do infinite banking. And a lot of people ask, well, Brian, then why would you do this kind of thing for other people if it takes such a big cut in commission? Well, one, I have integrity, I have morals, first off, but the main reason is this: is I would not go sell an IUL or term insurance, maybe term insurance if it makes sense, or a traditional whole life policy to my parents, my brother, my sister, my family. I would not sell them something that I would not sell to my own self. I wouldn't sell that to myself, so why would I sell it to my family? If I wouldn't sell it to my family, why would I give it to you? And I say sell because I'm not really selling anything, by the way, but why would I give it to you if I wouldn't do it to myself? That makes no sense. It's like going to what's a good example of this? It's like going to go buy a Harley, like a high-end Harley, from a guy that only rides a bicycle or only rides a Honda motorcycle. You're going to want to buy something from somebody who uses what they're talking to you about. Like, by the way, this happened here recently on a phone call. So somebody went to go, they heard about infinite banking and said, oh, I'm going to go to my financial advisor. Yes, yeah, selling Fords but owns a Chevy. Exactly. There you go. But this person went to this financial advisor. This is a couple of weeks ago, and the financial advisor says, "No, I can't do that. I don't know how to do that." Now, this financial advisor was very good because he said, "No, I can't do it," because he didn't know how to do it. Most financial advisors would say, "Don't do that. That's a scam. Just give me your money. I'll make you a bunch of money in the markets." Okay. The reason why we don't do IULs, by the way, is because we're tied to volatility. It's called an indexed universal life, and they never perform, in our experience and our studies. They never perform how they tell you they will. And there's hidden fees, there's hidden costs. And I've had so many clients that come to me with IULs that are pissed off and upset because they got pitched this whole thing that wasn't true. Anyway, so this financial advisor goes to my client and goes, "Hey, I've never seen this before." And I gave them the illustration to the client, and the client showed it to the financial advisor. The financial advisor goes, "That's pretty amazing. That's pretty impressive. Can you set me up a call with that agent so I can talk to him about doing a policy on me?" So I kid you not, I have done policies on financial advisors, other agents that don't know how to do this. I've even done them for Dave Ramsey coaches, which, if you know Dave Ramsey, he's against infinite banking because he's, well, self-fulfilling. I don't know, I won't get into that, but yeah, I've done it for coaches on him. So yeah, so there you go. And then, by the way, we only do infinite banking. So that's what we do. We do infinite banking. We don't do IULs. We don't do these other products, these other things that just are not a fit, by the way. So Kathleen, so to find the juvenile policy presentation, I've done it twice now. I did it on Wealth Wednesday webinar. I did it here about, I don't know, 4 weeks ago with Chris. So just go to Chris's YouTube channel, go to the I don't know what they call it, the playlist that is Wealth Wednesday webinar, and then type in juvenile, and then I think you'll see that recording there. A great presentation. Let's see here. Let's see. Someone asked a question here. Yeah, there you go, Anthony. So Monica says, I'm currently paying into my policy $74 for 50K. Can I transfer that to this one? Monica, depends on what kind of policy that is. If it's a term policy, IUL, whole life. So I would just recommend scheduling a call with me. I'll put my call link down here again. And then we can go through what the options are. Obviously, if you're paying $74 per month, it's not an infinite banking policy, but it might have cash value that you can maybe put into it. So there's my call link right there. And then I'll send it to me then. So here's my email address. I don't know when you sent it to Jason though, but there's my email. Just go ahead and send it to me as well. Yeah, Eva, thanks for being here. Oh, Monica, so yeah, someone called me trying to sell. See, if they're calling you to sell you IULs, that just pisses me off. I'll be honest. I just hate that. I hate that, by the way. Yeah, that's insane. They would call you to sell you something. We don't ever do that, by the way. I mean, really, we want to make sure that you understand infinite banking first. But we want you to understand it first so it makes sense. Like, don't do something until it makes sense. So someone asked that question about, I can't remember what the question was, but I said, I'll tell people this to your face or on call. Don't do infinite banking until it makes sense to you. It makes sense to me all day long. It does not mean you should do it. It's got to make sense to you. Right. All right. So Sissy, are these policy age restricted? To a degree, yes. Mid to early 70s is when it gets kind of a little challenging. Yeah. Yeah, Anthony got his at close to 60. Yeah, Frank, get more business being trustworthy. Well, we also get a lot of haters because we are so large, and because a lot of clients want to work with us instead of other people because of how much content we put out there, how much value we give out there, these kind of presentations, etc. So yeah, so we do get a lot of people that, and I know some of my friends are like, oh, Brian, you're stealing clients. Like, no, we're not stealing them. We're just giving value. That's it right there. It's giving value. Yeah, Anthony said it took me 2 years to figure out IULs and 1.5 years to see how infinite banking works. Yeah, it can take some time, but once again, you got to go on your own journey to it. Yeah, there you go. And then I thought another question I saw on site here. Yeah, Anthony says IUL is a good strategy, but need to look under the hood more. So a lot of problems with IULs is that somebody has one, but they don't know what they have. They come to me and say, oh, I've done infinite banking. I'm like, okay, let's look at it. And then I walk them through it and they're like, what is going on? This is not what they told me. Oh my gosh. And then they get all pissed off because the other agent did not explain the vehicle or the product. But a lot of people get stuck on the product, which is the engine. Remember? So think of remember, the policy is the engine. It's got to be the right engine. You cannot put a Ford engine in a Honda. It won't work. IULs are like trying to put a Ford engine in a Honda. I believe that, by the way. So you've got to have the right engine, but the thing you want to focus on is driving the car, which is using the infinite banking concept. The policy is the policy. We'll build it the right way for you for what you're trying to accomplish. And thanks, Monica. I'll take a look at it. Yep. It's kind of funny. Anthony made a good comment. He's on these things pretty much every week because it's not just me always doing this. It's other people, but he's here always learning. Nonstop learning is what's going to make this really successful for you. All right. Yeah, more like putting a kit on top of a VW engine. Yeah. Oh my gosh. What's the kit they do on top of those? Like the Ferrari kits or whatever. Because I built a Shelby Cobra, but it was a brand new car. It wasn't like I put it on top of a Mustang, which is, yeah, same thing. Some people are probably asking, what are you guys talking about? Okay, so a couple quick last slides here real quick. So one of two things will happen to us. Yeah, and then try to sell it. Yeah. One of two things will happen to us in life. Well, one, we're going to live. We're doing it right now, by the way. So are we better off with this in our life when we're living or not? Obviously, I believe we're better off with it. And then we also know that we are going to die. So are we better off with or without infinite banking when we pass on? Well, if you looked at the numbers I showed you previously, obviously multiplying your wealth times 3 times 4 times 5 times 10 for that next generation, better off with this. Yes to both of these things. Yeah, Shane said that right there. So next steps, let's hop on a call. Let's solve your problems, answer your questions, and seeing if this is a fit for you. Because I'm not going to tell you that it is a fit for everybody. I have denied people policies because it was not a fit and it would not benefit them. In fact, it probably would have hurt them because they had extremely bad financial habits. And they had to get those things fixed first. So it's not a fit for everybody. I believe it's a fit for around 5 to 10% of the population. Another comment I get a lot is, oh, it's too good to be true. Well, let me ask you a question. If you're going to go to like this exclusive club and there's 100 people outside trying to get in, and they only are going to let 5 people in the door, and you're not one of those 5, is that club too good to be true? No, because you can't even get in. Infinite banking is the same way. You have to be responsible, financially, literate. You have to be obviously pass the health and financial screenings, 5 to 10% of people. But I believe it's worth it to try to find out if you're one of those 5 to 10%, because it definitely is worth it. So I'll leave it with this quote here. Once again, the problem in America isn't so much what people don't know. It's what people think they know that just ain't so. Yeah. Yeah. There you go. Yeah. You can't take all clients, right? So I can't help everybody, but I can help those that want to be helped. Put it that way. But yeah, good comment there. All right. Any last minute questions? Any thoughts? Anything else? Otherwise, I will let you go. All righty. And by the way, as I'm on this presentation, I got actually 2 text messages from existing clients right now asking questions. I'm going to go answer those questions for them right there after this call. So thank you, everybody. I hope to see some of you on my calendar so we can actually go through your situation, help you solve your challenges and accomplish your goals. So with that, take care, everybody. Have a great rest of your week, and I look forward to talking to you soon. Bye.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.